Hello and welcome to another episode of the Sterling Southgate Property Podcast with me, Jonathan Southgate, head of Sterling Southgate. Today we have got the wonderful Ben Lee with us. Ben Lee is an accountant. He's a chartered accountant, business specialist and business services and tax director for PKF Francis Clark, easy for me to say. He's also a property tax specialist, which is why he's perfect for this podcast. So without further ado, I'm going to bring Ben into the room and let's have a quick chat with Ben. Hello, Ben.
And here I am. Hi, Jonathan. How are you doing?
Very cobbled entrance there for you, but I suppose it gives a good segue for me to lead off with, give the audience a bit of a background about you and what you do.
Yeah, absolutely. So, as you've already covered, I'm Ben Lee. I work for a firm called PKF Francis Clark, which are the largest accountancy provider firm in the Southwest. In terms of my background, which you sort of already covered, I'm a chartered accountant and chartered tax advisor. I have a portfolio of clients ranging from sole traders all the way up to listed companies. So there's a range of different matters that come with that. But as you alluded to during my time, my jail sentence, as it were, as an accountant, along the way, I've I picked up a niche, as it were, for property tax. And it's something I'm generally interested in. Interested. We're talking about tax interesting here, which probably isn't that interesting for a lot of people, but I'm here to change your opinion on that. So, yeah.
So how did you get into it? I mean, did you wake up one morning as a young 14, 15-year-old Ben Lee and go, tax is where I'm at?
I would love to tell you that were the case, but no, sadly not. No, for my sins, I did a chemistry degree. And when I came out of university, I'm pretty sure, this is my recollection of it at least, that they give you this sort of handbook of jobs that you can do after you've got your degree. And I remember looking at it and I opened it up and I got to A and I got to accountant and it was a really big book and I tried to get past accountant and I never did. So that was the life for me, which is sad because I never became an astronaut, for example, because I just never made it that far into the book, sadly.
It's their loss. Massive loss is PKF Francis Clark's gain, right?
I can only imagine. But here I am, talking about tax.
It's funny you mentioned that. The list as you come out of university. Well, back in my day, we're similar ages, aren't we? So that's that'd be back in your day as well, hopefully.
Do you remember
back in the day? Do you remember the system Kudos when you were a kid, which you used to just tap your things you like doing into, and it's like an employment database, and every single time it put me out at like estate agent sales or telephone sales, something like that. Which is
you were pretty boring back then.
Yeah, boring. Vanilla's the way to be as a financial consultant or mortgage advisor. So yeah, best way to be. Really. Best way to be. Excellent. So you mentioned obviously already about your spectrum of clients from sole traders, mainly self-employed clients, big businesses as well. So directors of limited companies down there. So the talk today is predominantly around three main areas. So we want to run through the sort of taxation changes to landlords and property, different taxation between what they call for property owners who are individuals or special purpose vehicles, so SPVs. So like a little bit of rundown on that. And obviously capital gains costs and all those bits and pieces we'll come to. Third point, really want to run down current tax treatment for sole traders and what's expected when they're likely to submit a return. And then we've got a few other little bonusy bits at the end there, which we'll spring on you as well. So yeah, let's kick off then. So 2021 to 2022, taxation for buy-to-let landlords. So what's expected of our landlords when they're filing and how does it differ? Because I know there were changes brought in the last 5-6 years. What do our buy-to-let landlords expect today?
So if you are operating a buy-to-let property, then you have, I'm going to talk very generally here, there are some reasons why you might not, but very generally, you have an obligation to file a self-assessment tax return. Now, most people who are employed, you get a paycheck, everything's dealt with, you don't have to do a tax return. But if you were a buy-to-let landlords, and you might do that full time. You might have a lot of buy-to-lets, or you might just have something on the side because you're employed. But what you have to do is you have to register with HMRC, and you have to submit a tax return. Now, the deadlines for doing that are you have to register as a landlord with HMRC by the October following the tax year end in which you became said landlord, i.e. you started receiving rents and etc. So, and then you have to file a tax return by the 31st of January following that tax year. So if you're looking at the period 2020 to 2021, i.e. the 5th of April 2021 that's just gone, then you would need to have all of your tax affairs up to date, filed, submitted with HMRC with any tax paid by the 31st of January 2022.
Brilliant. So cut and dry. If you bought the buy-to-let property July last year, for instance,
yeah,
when do we need to submit?
Yeah, register by October, submit everything by the end of January. I will say that January deadline is for electronic submissions, which most people do these days. Yeah. If you are doing for any reason, a handwritten tax return, they have to be sent in by the end of October.
Okay, and the online's pretty straightforward, right? So I mean, it's government gateway codes, all that good stuff, but it's pretty straightforward and self-explanatory for anyone who's used to using a computer on a day-to-day basis.
Yeah, absolutely. So you can, there's two options of doing it. You can either go online and do it yourself. You can, as you just said there, go online, get a government gateway, set yourself up. You can then submit your tax return yourself if you're happy and you're confident with what you are doing there. Or obviously, talk to an accountant, talk to a tax advisor.
An accountant. There you are. That's why you're here.
And get them to help you with it, because sometimes it, like a lot of areas of business and tax, there's a lot more perhaps behind the scenes that some people might not be necessarily aware of. So, whilst there's a cost there, actually the value that's provided in having that advice is certainly worth it.
And from my own personal experience of having an accountant, it gives you time back to work on the business. They take every care of everything. And if you've got a good working relationship with that accountant, they'll also give you a heads up on changes, or, take a look at your situation throughout the year and see exactly what you can offset, what you can't offset, and what your liability is due to be. But yeah, so property tax then. So if we look at buy-to-let landlord, Mr. and Mrs. Smith want to go out and buy a buy-to-let property.
Yep.
What changes would they have seen as opposed to Mr. and Mrs. Jones, who bought their buy-to-let property 10 years ago?
Oh, God, 10 years ago, a lot of changes. This landscape has changed quite.
Should we move it 5 years, or is that?
Yeah, we can do 5 years. Let's do 5
years. Let's go 5 years.
Yeah, all the changes already happened in the last 5 years anyway. There's been a lot of change. So I can run you as quickly as I can sort of down the list. Previously, if you were to buy a buy-to-let property and start letting out, as we just discussed, then obviously you'd report your income through self-assessment. But there might come a time within those 5 years that you either want to sell that property, maybe it's not for you, maybe you want to sell that to invest in another buy-to-let property, etc. Now, one of the biggest things that's changed in that year is previously that disposal would have been reported within your normal tax return that you submit on an annual basis. Now, HMRC have come along and gone, no, that just won't do. You file a stamp duty return when somebody buys a house 30 days after completion. Said, you know what? We'll have our money then too, thanks. So now there's a 30-day filing period when you dispose of a property, in which you have to go online. This is outside of the usual self-assessment system. You have to report that gain, and if there is a gain due, you have to pay that within 30 days. The idea that it just comes out of the proceeds that you're collecting. Anyway, now, without getting too much into the detail, that can be quite frustrating, because say I had a diversified portfolio, I had lots of stocks and shares, and I had buy-to-lets, and I've made huge losses on my stocks and shares in the last 12 months. And I wanted to offset that against the gain on my property. Currently, there's not the facility to do that online. So you have to report a gain, pay a gain, and then almost wait till your self-assessment return comes along and then claim your losses against that gain you've already paid. So HMRC are quite happily to sort of sit there, take your money gleefully, until that period where you can actually file your claim and get it back. Now, obviously, you could file your claim early, and we could try and facilitate it. It's an inconvenience, to say the least. So sorry, that was one of the big changes that's really happened within this area. One of the other big changes, which has really, I think, disincentivized disincentivized.
That's the one. Yeah,
that's the one, isn't it? That's the correct one. People almost to go and have more buy-to-lets is this interest restriction. So again, previously, if we're going back 5 years, it's still accurate. If we're going back 5 years, and I've obviously got a mortgage, buy-to-let mortgage on my property, now that interest on the mortgage I could deduct against the rental income,
yeah.
Which would be great because then that reduces my rental profit. I'm not paying tax on that amount. Happy days. But what they started to do back from 2017 onwards was to restrict the relief you could get from your mortgage interest. Now, the idea here being previously, if you're a 20% tax rate, 40% tax rate or higher, you would just get that relief at whatever rate. But what they want to do now, what they are doing now, is restricting higher rate tax relief on that interest element. Now, whilst that might sound quite simple, unfortunately, the way that it is applied can be quite frustrating and can actually push people up into higher tax brackets, because the way that it's approached is to ignore the interest element. You would calculate your profits from your rental business, taking your rental income, taking all your usual expenditure, and you would ignore the interest element. And if you're ignoring the interest element, which could be sizable, the rental profits that you are declaring are therefore higher, and that could push you into a higher rate bracket. And the way that the relief operates is to say, well, actually, when we get down to the bottom line, you can have 20% of that interest relief down here. So what it can potentially do is shift people from being basic rate taxpayers into higher rate taxpayers and actually suffer a greater tax bill as a consequence. And they phased that in from 2017 onwards, and now where we are right now today, they sort of phased it in saying, all right, we can have 25%. Sort of restriction 50, 75, 100. Now, unfortunately, that restriction is in full effect. So that's definitely
100% now. Yeah,
absolutely. Okay. Certainly something to consider. I mean, there's more. So it's up to you here, Jonathan. I mean, I could talk all afternoon. This is tax, right? But those are two.
Let's push on. Let's go for it. Yeah. So what? Yeah, go for it. So those areas we've discussed obviously already. The disincentivization apparently from HMRC to almost they just flip that tax model so that I think it's a little bit easier to report from their side, but B, from a client's perspective, if they've historically done their own returns, they'll know that each year you've put in how much your interest is, and that just is. That bit's tax-free, done, because you've effectively, that's not gone into your pocket, it's gone into the mortgage lender's pocket if they're on interest only. If they're on a repayment basis, then obviously only a proportion of that will be the interest, and a proportion of that will be capital repayment. So a little more difficult to calculate in that regard. So, I mean, it was the aim to simplify the tax situation, or what was the aim behind it, do you think?
No, it's a lot of these have been geared because there just isn't enough available properties in the UK. The demand is outstripping supply. Yeah. So, back in, I think this was Finance Act 2015, it was that case of, right, well, we want to try and stop people from buying buy-to-let so there's more houses for people to buy. Yeah. And what they've actively tried to do is make letting less attractive for the landlords. There's things I haven't mentioned here, like lettings relief and rental room reliefs that have changed substantially in that time as well, that have restricted the relief that you get either from selling a property or from letting your house out that you used to get on an annual basis as well. So all of this is really geared towards those financial incentives that were available to do this, to really try and free up the market.
And not to mention the 3% overage on stamp duty as well, which is huge.
Well, I picked on those two. All right, thank you. I gave you the two. You said, then you go take the stamp duty one.
The thing is, obviously, from our side, we deal with people who are just going out and buying a buy-to-let because they want us. They've got £50,000 and they've got a long-term investment plan of, I want to have a property so I can have some income when I retire, some residual income over and above my pension that's not performed very well or whatever it might be, or for a bit of fun, or just have some bricks and mortar they can say, that's mine, great. Others are buying it for cash flow immediately, but they now have to factor these things into their costs, and it definitely has from our experience, we've seen less people looking at buy-to-lets and looking at other options of investment vehicles in the market. And we've also got a load of landlords that have got big books of buy-to-lets that are now at a point where they're now starting to think about disposing of them, and disposing of whole portfolios, because they can't necessarily sell them on, trade them on an individual basis because demand's not there as much.
I mean, there are stamp duty reliefs. Don't get me wrong. You know, there's multiple dwellings relief when you're selling. If you're selling certain amounts of properties in one go, then there are stamp duty reliefs available to you. But this 3% has been an absolute killer. I mean, you can see the way that the market's reacted with the stamp duty holiday.
Yeah.
You know, yeah, absolutely. Almost as not
petrol on the bonfire. Absolutely has. Yeah.
Absolutely. And you know, at that time when the additional charge came in, we were having so many conversations with clients about how to get around it. You know, there's this tax. Oh, that's great, but how do we get around that?
Where's the little nugget of information?
Yeah, they said that this is happening, but how do we just ignore it? And unfortunately, there's very little you can really do to get around that. You know, so yeah, it's tough.
It's an interesting area actually, because we do a lot of let to buys. So clients who are letting their own main residence and then purchasing onwards to buy a brand new main residence. Now, we've seen right at the start when the 3% overage came in, there were people who were saying to us, "This is well, I'm changing main residence, so I'm going from one main residence to another main residence. Surely I don't have to pay 3% overage." And then I think solicitors started cottoning on to that and getting behind the legislation a bit and saying, well, actually, no, you might be letting your £450,000 house out and buying a £650,000 house, but you're paying 3% on that new property.
Right. You can have it back when you sell that property, though. That's right, isn't it? You know, you have to pay it up front, but then you get it back within a certain time period of selling that property. But no,
would that be in cash, or would that be in a relief of some sort? How's that come? I've not actually seen anyone who sold that property.
Yeah, so I think the mechanism by which you reclaim that, if I'm right, because I haven't done one for a while, but I think you have to then, it's effectively a stamp duty relief form. So you pay it over, and you have to say, well, we've actually sold that now. Thanks very much. Can I have that back?
So proof of land transaction, off you go.
Yeah, absolutely. But yeah, I mean, even on that side, it's interesting you mentioned the lettings there, because that's another side they clamped down on. You know, there used to be a relief where you live in a house and you sell the main house that you live in as your main residence. You know, we don't pay capital gains tax on that in this country, but there used to be a period at the end of your let's say ownership of 36 months where it didn't matter what you did in that time, it would still be exempt. So I could move out from this house, I could let it for 3 years, doesn't matter, it'd still be capital gains tax free. Now they brought that down to 18 months because they said, well, no one's house stays on the market now for 3 months, which caused a bit of an uproar at the time. That's now down to 9 months because they believe that his house stays on the market for longer than 9 months at this point in time. And here again, we see the restrictions of these quite attractive lettings reliefs that they were allowing people to have during the ownership of their own houses that they've clawed back on as well.
Yeah. So huge changes across the last 5 years then. I mean, dramatic. And anyone who's not, I suppose, up to gend up, or they're not employing an accountant to look into these areas, don't know what reliefs they're going to get. So probably definitely worth speaking to an accountant to at least get that position.
Yeah. And I think just my advice there would be, it's always easy as an advisor when someone comes to us and they say, we're thinking of doing this, to advise, because we're looking at it. We can advise on what needs to be done to ensure that there's the necessary outcome, or whatever it is that we want to achieve is achieved. The worst thing is where someone comes along and goes, I've just done this. And unfortunately, there's often
we get a few of those in the mortgage market.
we can tell you what you need to do now, but there's very little we can do to help, I'm afraid. So here's that case of just being proactive and getting the advice that that's out there and can really help add value.
Good stuff. So talking of value, moving from that sort of traditional owner-led, owner-led buy-to-let portfolio where they've gone out and they've bought one, maybe two, maybe three, maybe four. But I can keep going, maybe 5. Buy-to-let. There's definitely been a shift from people considering other modes of ownership or other ways of owning buy-to-let property to try and make it a bit more tax efficient for them. Now, obviously, it's not for everyone, but we have seen the limited company special purpose vehicles coming into the market, or even pre-COVID. Over the COVID period, less so, but pre-COVID, definitely there was a launch towards clients just inquiring and saying, okay, well, I'm buying my first buy-to-let. Is this for me? Or I'm buying a portfolio from someone exiting. Is this for me? So perhaps just a rundown on what an SPV does and the tax treatment of that, plays tax treatment of, should we say Mr. and Mrs. Smith again? Because they seem to be
they're fairly active in the property market, aren't they? This couple.
Super active.
Out. Anyone looking at the moment, they've just been bought by Mr. and Mrs. Smith. They're on it.
They are gobbling up those properties, that's for sure. Right. So let's go run down then SPVs from the top.
So SPVs, love a good acronym. Special purpose vehicles. They're there to allow you to put whatever assets you're putting into them to sort of mitigate against risk. So in this case, we're just talking about a company holding property or a number of properties. And yes, we did see a sort of a movement around the time those interest restrictions that I mentioned earlier came into effect, because that is a restriction on income as an individual, but it doesn't apply to companies. So if I was holding a property within a company that was financed, actually I could still get that interest as a deduction against corporation tax. Yeah. So what I need to do is break this down a little bit more, because in order to get the property within the company, there's things to consider. You could purchase a property within a company to start off with, and that might be a convenient route to go down. Now, you're still going to have stamp duty issues. You're still going to have to pay stamp duty from the company, depending on what you're doing with that property. But here it's buy to let. There's obligations. There's a thing called the annual tax on enveloped dwellings, which applies to properties worth over £500,000 owed by a company. Very simply.
Total value or individual properties?
Sorry, say that again, Jonathan.
Is that total value or individual?
No, that's individual properties. Yeah.
So if you're a portfolio landlord in London or in the southeast or in a city somewhere, and you've got 5 buy-to-lets, 3-bedroom houses, and they're all £500,000 plus, it's individually that they'll be taken. Okay. Right.
Yeah, absolutely, and that's how it sort of started off. It was very sort of London focused. It was only for properties worth over 2 million, and then the government went, "Oh God, actually, there's loads of people have these. Let's drop it down." So they dropped it down to 1 million, and they just kept going. So they brought it down to 500,000. Now, if you're running a buy-to-let business and those are being let to third parties, then you are exempt from this, but there's still an obligation in respect to that tax. So something to be aware of. I feel we've got distracted by ATED. If you're transferring, if you're thinking, well, hang on a minute, I'm paying a lot here on my these buy-to-let mortgages that I have in my name, so I'll put them in a company where you've got chargeable gain implications. That additional charge, that 3% stamp duty we talked about earlier, is where you're buying it in a company as well. So it's a little bit of, is this right? Is this not right? And it genuinely just comes down to the figures. It depends on the level, what you're expecting to earn, and probably the mindset of the investor. Because whilst putting it into a company might look attractive, there's been a lot of talk recently. The budget was quite disappointing back in March. There was all this, stuff in the media about chargeable gains being aligned with income tax rates. Didn't happen. Maybe on the horizon sometime soon. May not be.
That's a live exclusive here on the Sterling Southgate Property Podcast.
I just feel the November address is going to be a lot more doom and gloomy, because we'll be ready for it then, so it'll be fine. But corporation tax currently is 19%. They are playing with that in the next few years, and you may see an increase, but the rate of capital gains tax that you pay in a company is at the rate of corporation tax. So that's 19%. Now, if I held it individually as a higher rate taxpayer, I would pay 28% on that. Yeah. So some people might look at that differential and go, I'll hold it in a company.
Yeah.
One thing to be aware of there is it's a lot more complicated potentially to hold it in a company, just from an admin perspective. You have more obligations. Not only do you have to file annual accounts, you have to file confirmation statements, everything needs to go to company's house. So you've got a lot of obligations there. You would need to have a director of the business. Now that comes with its own responsibilities. And obviously you'd have to have a corporation tax filing requirement as well. Not only that, you'd have to take your income out as dividends, and then you'd have to do an income tax return at the end.
Yeah.
So there's a lot to consider there. So it's not for everyone, but there can certainly be advantages to be gained depending on the situation.
Okay. So, going back to Mr. and Mrs. Smith, if they bought one or two privately and then they got a taste for it, then worth opening up that conversation to see, okay, here's our tax liability, here's where we are currently. We've got employed income, we've got buy-to-let income. It's the next best solution then to look at limited company SPVs. Obviously, I think this is one thing that clients have seen the benefit from our side, looking at those. I mean, the interest rates are slightly higher for SPV buy-to-lets, limited company buy-to-lets. There are companies that do them, and the mainstream companies. So, we're not alternative lenders for that sort of proviso. But they've been able to put their cash into the limited company and then utilize that as a director's loan. Is that correct? That feels like I'm on the right track.
Yeah, you can do. So where you are putting your own money into a company, obviously as a director, you are lending the company money, which means you can extract that money tax-free at a later point in date. Now, whilst that sounds, oh great, that's sort of a tax, we've beaten the tax man. Well, you haven't really. You've put your money in.
Yeah.
You get it out again. That's almost like you're a tenner, and at some point, I hope you might give that back to me again. Like it does. It's attractive. It is nice, obviously, if you are going to be taking out, if you're selling properties within a company and actually you want to draw that cash out, then having that director's loan account can make that very appealing from a cash flow and a liquidity aspect. Doesn't really affect any other aspects of your chargeable gains or anything else, but it is potentially attractive.
Well, that's it. I mean, you're putting the cash in, you're taking the cash out. It's very, very simple, isn't it? It's not a case of you're getting money for free, because you're really not. You've had to forsake having that money in your pocket or in your account and put it into some physical asset. So to recuperate funds out that, yes, you might be able to draw down, the equivalent monthly income from the property tax-free. You're only pulling out what you put in, and eventually that's going to run out.
And I sort of think going down those lines, people can get drawn into things like that, but there's a lot to consider in the round, because if you came to me and you said, you know what, Ben, I've got these 4 properties I bought off Mr. and Mrs. Smith. They were having a fire sale. They were just getting rid. They've got too many. I'd be like, right, that's fine, Jonathan. What we need to have a look at is, right, let's look at your tax position. Let's look at the value of the properties. Let's look at what the value of the properties were when you bought them versus what they are now when we're transferring into the company. Right, what are the stamp duty aspects? Because there will be a tax charge to wrap them. Now, what we need to quantify as accountants, as advisors, is, does that charge and that hit, if you're putting things in, have a benefit further down the line in what you would save on the other side? So it's a numbers game at the end of the day.
Yeah, sure. Good. Yeah, that's comprehensive. Love it. And I think, again, each individual's got to just assess their own situation, or have an accountant like yourself just assess their situation, see if it's worth them doing. Certainly, potentially for those high rate taxpayers, worth just delving into it a bit more. A lot of them got the liquidity, they want to invest in property or see their money return. Maybe not now, maybe not 5 years, 10 years down the line. They want to see a better return on their money. So less tax potentially in that period, depending on what they take out. Cool. So obviously we covered off limited company SPVs and a bit of a tax treatment for buy-to-lets. So let's just run through our sole traders currently. Current tax treatment for sole traders. From our side, when we're submitting a mortgage, there's certain documents that we require to be able to submit a mortgage. How can our sole traders make their lives easier, and what do they have to provide to you? So say Mr. and Mrs. Smith have now decided, off the back of owning buy-to-lets, they've quit their jobs, they're setting up their own boutique cake making business. So what can they expect? What would you expect from them, and how can they make their lives easier? What sort of systems, tools are out there for them?
Yeah, of course. Now, you will probably have much more of an insight into sort of what lenders are looking for here, but a lot of it will always come down to lenders obviously want the assurance that you can meet the debt of the mortgage, those repayments. So what they will be looking at are the accounts, sort of the annual accounts that you either produce as a sole trader or your tax return information. And where you've been a sole trader for a long period of time, they'll want 3 years worth of sort of tax returns, and sometimes forecasts and projections going forwards, just to say, right, okay, you tick the box with your earnings historically. Looks like these are all good for the future. Big tick. Now I'm sure it's more complicated than that, but that's that's the sort of the side we see.
Absolutely. I think the interesting thing we've seen, obviously, the last 12 months with the SEIS grants and all the other stuff that's coming from the government support, but just before COVID hit, there were some lenders that were looking at 1 year's accounts, 1 to 2 years average, or latest year if it was slightly worse. Some lenders, again, it depends which lender you talk to and which lender you go to, but some, if you're at certain loan to value, you just look at latest year's accounts as long as it meets the need of what you've got. So that was pre-COVID. We're starting to see a shift back to that. Now, the SEIS grants have been a big thing for lenders, saying, well, why have you taken this chunk of money? Did you not have anything saved? Did you not have, have you not been in a position where your business could sustain you not having income for a sustained period? Well, not many business owners have that rainy day account, especially if they're sole traders. They've been trading for 2 or 3 years. They haven't necessarily had that. But I'm pleased to say that we're starting to get some sense. So a couple of high street banks, I know I'm going off a bit of a tangent here, but a couple of the high street banks have actually have started saying, well, actually, we won't worry about those grants. Bounce back loans slightly different, but grants, as long as we can see, the last 3 to 6 months trading has been back to pre-COVID levels. But I've just walked all over what you were going to say there. So
no, not at all. No, I think that's very interesting. A lot of the things that I end up putting my name to and signing off in respect of clients' applications, normally we're having to sort of provide the sort of the tax comps and the sort of proof of what's been paid to HMRC for 3 years. So I actually, that's really interesting. And we work with clients to put projections together. Now, there's a lot of tools that a sole trader could use to help themselves. One of these is always going to be records, in terms of putting that tax return together and understanding your accounts. And we get people who have varying degrees of, I'm going to say, sort of time commitment to sort of either doing the accounts themselves or getting someone else to do them. But there's software out there now, you can't escape them. Things like Xero, things like QuickBooks, they do make a lot of the bookkeeping aspects easy. There's a lot of automation there and machine learning to try and actually speed up that process. You will then have good data to give to an accountant at the end of the year, or for yourself to look at and have that confidence about putting that in online. But also, let's consider the tax system that we have at the moment. So, one of the first things I did in this talk was mention that annual filing obligation for our tax returns. Now, that's true for now, but we're seeing Making Tax Digital come in for income tax potentially in 2023. If that happens, we're seeing a lot of changes in our tax system. I still think the UK is quite far behind in having a robust digital tax system. And at that point in time, certain individuals and sole traders will be required to have these digital records anyway. So don't shoot yourself in the foot by just thinking you can do that on the back of a fag packet for the next 2 years, because ultimately you're going to have to probably change to something like what these software provides in the future. So I just say, get on there now, get good records, get everything up to date. It's going to make your life easier going forwards, and you'll be on that curve as and when the change happens.
So they're quite straightforward systems as well, aren't they? Like there's like a snap a receipt, it'll log it into your system, into Xero or QuickBooks, and they're starting to get more intuitive. Yeah, that's the word. Having all fun with the words today. Intuitive, understanding. If they see a shell receipt, okay, that's likely to be fuel. In the fuel section, and you just click OK. So I mean, do those systems, obviously it must make your life a little bit easier for clients who are using those systems to then, do you have access to their side? Or
it's all at the client's discretion, but more often than not, clients are more than happy for us to have that, because what we will do is periodically go in and and have a look. It sounds like we're snooping. We're not snooping. We're not that nosy. But it's nice to be able just to sort of go in and have a check of how things are now. From our point of view, it helps us and it helps the relationship that we have with our clients. We might be able to spot things. Going back to what you said, No, I am me, you are you. Just had to remind myself there. What I said earlier about clients coming along and saying, we've just done this. You'd be amazed at the number of times we might just sort of just be like, oh, we'll have a look, see how things are for the quarter, and hang on a minute, what's this? But we can have those conversations then, rather than a year later down the line, where you're going to your accountant with that information, and then they're trying to sort of
bag of receipts on the 28th of January. Going, thanks a lot. Can you sort that out?
Yeah, absolutely. So I think, and as and when you get a problem, then you can call up your accountant. They can take a look. This is real time advising, which, let's face it, we're in 2021. That's where we should be.
Yeah, sure. So for Mr. and Mrs. Smith set up the cake business. They set up a sole trader. They're going to get themselves on zero, get themselves linked with a decent accountant, and then that will sort of put them in the right state to run their business effectively and stress-free as well, not having to worry about the tax deadlines and stuff like that. Because I have someone like yourself on their team and a bit of software there to integrate, because some of those softwares also integrate with bank accounts and
so
it's pretty smart stuff.
I mean, if you're doing big scale, there's even add-ons you can get. I think there's one called Arthur, which is a whole sort of property management system that you can tag inside of Xero, things like that.
Yeah, cool. So should we go for some top tips then? So I'm going to bring up our top tips slide. I know we are moving with the times. We're very 2021 here. Also, I think we'll have the top tips tab for anyone who's listening rather than watching. And it's cool, quite a chuckle. So there we go. So top tips for, let's go in with our 5 top tips for anyone who's started a business, runs a business, how they can really make sure they've got stress-free accounting profile. And if that's clear enough.
I'm worried that was my whole take on this talk, and I've already given those top tips away. But we'll see how we do. But
recap then.
So I can't stress this enough, but the number one thing has to be records. Keeping good record, and I don't just necessarily mean accounting records. If you buy a buy-to-let property now, and 20 years down the line you're coming to sell it, then as your accountant, I'm going to ask you for that completion statement. Why? Not just because I'm a really annoying accountant. I mean, I know I am, but that's not the reason I'm asking for that. It's genuinely because we want to know the price that you paid, but also incidental costs, things like, what were the legal fees at the time? What were other things at the time that we can use to offset on your capital gains tax? That's really important for us. So records in terms of bookkeeping records, but also records with things just to do with the property, the big ticket stuff. I think the second tip is really maximizing your reliefs, the expenditures. So I think people might just sort of go, oh, and I have seen this in practice. People go, oh, I've rented my house out. It's £3,000 a month. Here's my rental profit. It's £36,000 a year. And I'm thinking, well, that's great, but what costs do you have? And people have a variety of expenditure that they can offset against this. I think that's good. We're good. We're talking about things like, are there any utilities that you've had to pay as landlord? Have you done any refurnishings? Do you have to get in your car and drive to your property sometimes to go and see these things? Do you have a letting agent? There's lots of costs and things like that you can offset.
Inventory costs, all those kind of things as well that come into just the cost of sale, I suppose.
Yeah, absolutely. So make sure you're on top of those, or again, your accountant should be advising you accordingly on all the reliefs that you can claim. The third top tip, unfortunately, isn't really a tip. It's just something to be aware of. They're called payments on account. Going back to this annual tax return filing, the first time Mr. and Mrs. Smith file their tax return from their cake bakery, as well as their buy-to-let property, what will happen is they'll have a tax amount due at the end of January. But the way HMRC go about collecting the money is they'll take that amount that's due, but they'll also take half of that amount again in January and half of that amount again in July.
That's massive.
You're paying. So what? Let's say I'm paying £100 in January. That'd be a nice tax bill, but £100 in January, and I'm having to pay £50 in January again and £50 again in July, so that the time I come around to next year's tax return, effectively, I've already got £100 sitting on account. And HMRC do this on the basis that, well, if your circumstances haven't changed, then, you won't have much to pay. Yeah. But it's really their way of just collecting the tax up front and being able to sit on it for a bit longer than perhaps they might need to. So if I was a basic rate taxpayer, rather than thinking, well, I'm going to have to pay 20% on this, well, the first hit is going to be 30%. And I'm going to have another 10% in July. So these are really, this really catches people out, and it's really something to be really up to speed with.
Yeah.
Fab. Is that 3? Are we on 3?
That's 3. We are on number 4 now.
Fantastic. So number 4, I always try and let clients know this, but just get things done early. I think if you're a sole trader, you've gone past the end of the tax year. You might have chosen the end of March as your sole trader accounts period anyway. It'd be nice, coterminous with the tax year end, but you've got from that point in time to the end of January to get your tax affairs up to date. Now, your tax bill is unlikely to change whether I tell you what that is in April or whether I tell you that on the 30th of January. But the difference is, if I tell you what that is in April, you've got best part of 9 months.
Yeah, 9 months. Yeah.
To effectively make sure that you've got the money to pay that tax bill. It's not a surprise. It's not a nasty lurking in the corner. So it pays to get these things done early. Also, we were talking earlier before about the information required for lenders. Well, there you go. Fab, just got your last year done. You've got that up-to-date information rather than having to go, oh, sorry, lenders, do you know what? I haven't got the stuff together. I'll get it to my accountant in 6 months' time and we'll revisit it then. Just try and get things done as early as possible.
And in the absolute worst case scenario, it just allows you to prepare for that tax bill. If you've had a phenomenal year the previous year, even if you're not having as good a year that year, you know that you can stash the cash, keep it away in an account, ready to pay that tax bill. It does catches people out. It does. I mean, how many times you sit down, how many times do I sit down with a self-employed client and go, I've just had to pay a really massive tax bill. The only reason they've just had to pay a really massive tax bill is because they haven't thought about planning it in well before. And just putting a few hundred, depending on how big they are, £1,000 a month away extra, it's only money they're earning out of the business. So if you're earning it, you pay tax on it.
Be prepared, because otherwise you're going to fund that from cash that the business might need. You're going to run into liquidity problems, and you're always chasing the tail. So,
and it's great also for those clients who are remortgaging. So if you're thinking about remortgaging and your mortgage comes up the following year, as brokers, we love just to have a little insight on how the business is getting on. So if they've had a really strong year and they're looking to move home, then we can make sure that when they come to, we can explain away to the lender why it's gone from £30,000 to £50,000 profit. We can just, because we've got a better understanding of it, rather than just having them drop in your lap and go, hey, well, thank you very much, go and find us a mortgage. So it's better to be prepared, and if we've got that heads up ourselves, then we can make an informed decision about which lender stream we're going down, really.
Yeah, absolutely. So the fifth and final thing, I think, from a preparation point, I've thought of it. I almost want there to be 6 points. I might have to tag another one in. Sarah,
that's fine. Yeah, go for it.
So the last one, formally, I think, is the software element. Times will be changing. We are moving to a more digital tax-based system. You can either be an early adopter of that and understand it prior to these changes, or you can wait until HMRC forces the hand. And that's going to be a much bigger learning curve at the time that happens. Perhaps at a time when actually your efforts are better spent elsewhere within the business. So while you've got the time now, I think get those records onto cloud-based software, get ahead of the game, and then these things won't take you by surprise. And then the fifth and final point, again, the last one, he says, we don't see this often, but we do see it. There is an element of some people out there thinking, well, I'm going to buy a house, and maybe I'll let out my own house. HMRC are never going to find me. It's all right. I won't bother disclosing it. That chap that sat there in a strangely pink jumper has just told me that I have to file a tax return, but HMRC aren't going to find me. It's happy days. Unfortunately, that's not true. And I would say this because I'm a tax advisor. But you have an obligation to disclose that income. So this is taking a very dark turn at the end of an otherwise fairly happy tax-based chat. But there is an obligation there, and the reason that I'm saying this is because if HMRC find you, then fortunately what they will do is they will level penalties, and they levy penalties based on behaviour, and where they believe that behaviour is deliberate and you have tried to conceal something, then they will throw the power that God has instilled in HMRC at you to recover that tax.
So I suppose that also works for those clients who've been portfolio landlords for many, many years, and they haven't disclosed for one reason or another. Maybe they felt their interest was that high they didn't have to disclose, which is an obvious one that people come to us and say, "Oh, we've got buy to let. Well, where's your SA 302? Where does it show it? Oh no, well we don't make anything much out of it, so we don't actually have to submit a return." And I did actually have a client who went down, is it a let property disclosure? There's like a scheme at the moment, or schemes out there to say, look, you come to us, you go to the HMRC and with your hands up and say, look, we didn't realise we haven't paid tax, or we haven't paid tax, and then they'll think of it a little more favourably than them knocking on your door.
Yeah, absolutely. That's absolutely right. I mean, are you sure you're not a tax advisor? They HMRC do absolutely. They basically say, look, it's okay, guys. Like we're the frustrated, disappointed parent here. But if you come to us and tell us those things you did wrong, then we'll look slightly more favourably on you than perhaps we would if we find out that you've been lying. Absolutely. So just a delightful moment to end on there, I'm afraid.
Awesome. Well, there you go. So we've had a big old roundup there. Obviously, there'll be some nuggets of advice in there for people, also stuff that people weren't really aware of. So that's grand. So if we can educate and add a bit more information to people, that's grand. If they wanted to go further than that and get in touch with you, then you're prolific on LinkedIn. If I don't say so myself, you are prolific. You're on every panel for everything at the moment. It looks like, so can't turn my head on LinkedIn without seeing your name in lights. That the best way to get hold of you, LinkedIn or via?
Yeah, I think that's probably one of the most convenient. I mean, you could go to our website. If you just Google PKF Francis Clark, or even just Francis Clark and Bentley, you'll find me. My contact details will be there. But as you say, I think coronavirus has forced me to live my life on LinkedIn rather than in person. So probably quite easy to find on that. And just pop me a message and we'll have a chat.
Thank you so much. So yeah, that's been an end of a really good tax talk, which those words are never really said in the same sentence. So yeah, thank you once again, Ben. And as per usual, I'll lay on the additional disclaimers once we've tidied up today. So thank you very much, and speak to you soon. Cheers, Ben.
Cheers. Thank you very much.